Here's what analysts see after OPEC Plus shock cut. Now, the decision by the Organization of Petroleum Exporting Countries and its allies to slash its oil output came as a huge surprise to the market, given earlier rhetoric from group leader Saudi Arabia that it would stand pat on production. The move has brought concerns around inflationary pressure back to the fore, adding to worries that higher prices and an aggressive monetary tightening by central banks could tip the global economy into recession. The White House has described the OPEC Plus decision as ill-advised under current market conditions and added that the U.S. will work with producers and consumers to manage gasoline price for Americans. Here's what analysts are saying about the shock OPEC Plus production change. Goldman Sachs Group. OPEC Plus has a very significant pricing power relative to the past. Analysts including Dan Struven and Callum Bruce said today's surprise cut is consistent with their new doctrine to act preemptively because they can without significant losses in market share. This, combined with the extension of the Russian production cut, led the Wall Street giant to raise its Brent oil forecast to $95 a barrel for December this year from $90 earlier and to $100 for December 2024 from $95. Unlike during the previous OPEC Plus cut in October, the momentum for global oil demand is positive amid a strong recovery in China and resilient refining margin, Goldman added. Bank of America Corp. Now, any unexpected 1 million barrel per day change in supply or demand conditions over the course of a year can impact prices between $20 and $25 per barrel, said Francisco Blanch, head of commodity and derivatives research at the Bank of America. OPEC is no longer afraid of a major U.S. shale oil supply response if Brent crude oil prices trade above $80 per barrel. So, cutting volumes to push oil prices higher does not carry the same risk it did 5 years ago, he said. Still, it's unclear how much of the planned cuts will result in actual volume reduction, given that OPEC has historically failed to fully implement agreed cuts, he said. Now, Bank of America maintains its Brent forecast of over $90 a barrel in the second half of the year. Citigroup Incorporation. OPEC Plus resumed its recently abandoned decision to become the central bankers of oil. Citi analysts, including Ed Morse and Francisco Matussier, said, given extremely low managed money positioning, low open interest rate, and high volatility, the market can expect a price overshoot just as Fed tightening and banking turmoil led prices to fall 2 weeks ago. Far more than balance is warranted. RBC Capital Market. Now, the surprise cut by OPEC Plus could result in an actual reduction of about 700,000 barrels a day in output, despite the headline figure being around 1.65 million barrels a day, according to RBC analysts including Helima Croft and Christopher Looney. Still, the move can be read as a signal that Saudi Arabia and its OPEC partners will seek to short-circuit further market sell-offs. The Saudis have expressed clear concern about aggressive Federal Reserve action, macro uncertainty, and what's being seen as an overly bearish bias in the market, they said. ANZ Group Holding Ltd. The probability of reaching $100 before the end of the year certainly has increased following these measures, said Daniel Hines, ANZ Senior Commodity Strategist on Bloomberg Television. Like the rest of the market, I was quite surprised by the move, he said. This measure does not send a pretty strong signal to the market that they're going to support prices. Commonwealth Bank of Australia. Now, the announced cut from OPEC Plus will amount to about 1.1% of global supply in the next 2 months and about 1.6% of global supply in the back half of this year, said Vivek Dar, Commonwealth Bank of Australia's Director of Mining and Energy Commodities Research. The 8 countries are planning to shift production to have the capacity to do so, he said. So we are talking north of 1 million barrels a day. That can be an actual reality, Dar said. People should be paying attention to these cuts because they can actually be realized. Skandinaviska and Skilder Banking AB. It's easy to cut when there's limited risk for loss of market share to U.S. shale oil as growth there slow, said Jan Schildrup, SEB's chief commodities analyst. More market power to OPEC Plus and higher oil prices is a natural consequence of fading U.S. shale oil growth. The cuts will help to drive Brent faster back to the $100 per barrel levels as the global jet fuel demand revives, he said. We have previously argued that OPEC has a lot of dry powder in terms of yet unused potential for further production cuts, Schildrup said. This still holds true even after the latest cut. The consequence is that there is still limited downside price risk. Now, Vanda Insight. The move has potentials to push the market into a deficit in the second quarter versus early expectation of a surplus, said Vandana Hari, Singapore-based founder of oil consulting firm Vanda Insight. Higher prices may curtail some demand for crude as well as exacerbate the stubborn inflation that central banks are trying to combat, adding to recessionary risk, she added.